Today we're going to be using the risk management tools, and that's going to help us to make sure that we're buying the right amounts. Okay, so the first thing we're going to do is when you come into your risk management, you're going to want to set these values to the amount that you have in your balance. So this first one is your total balance across all different exchanges, let's say. So here, I've got three different exchanges which I've added to the APIs. And so let's say across all those balances, let's say I've got $10,000, right? And that's just what we're going to imagine that we've got today. So the reason to have this across all your balances is because let's say, you've got different trades going on in different exchanges. If there's a market crash, all those trades are going to crash at the same time. So you need to have a sense of how much you're risking across all those different exchanges, okay, and all your different cryptos, right? That's what we're trying to do here. We're trying to say, what's the worst possible scenario and make sure that we account for that risk in the worst possible scenario. And that's really, really important because that's what's going to take you out. Losing one trade here or there, it doesn't really matter so much. It's less important. The main thing to focus on is the fact that as markets are correlated, you need to make sure that you understand the total amount you're risking in the market and how long you can survive if things start going wrong. So what people usually want is they want something that ticks over slowly, where every day they're making a certain amount of money. So as markets correlate, they all tend to move together. So you're either making money all in one moment or you're losing it all in one moment. There isn't this diversification of some trades are going really well and some going bad. It does happen a little bit, but in general it doesn't. And if you look at how the market moves, it kind of becomes clear why that's the case. Okay, so this is a chart of the market moving in and out of cryptos trending above the 100 moving average, and you can see that this isn't a flat line where there's an average amount above the 100 and below it. So that's like a good indicator of whether they're trending or not, whether they're above the 100 moving average or not. Between this range, there's a huge movement of the amount of cryptos that are trending at any one time, and that's really important because what's important to understand, because what that's telling us is that there's something happening here where because the markets are correlated, we have to understand when it's kind of at this point where it's beginning to fall and when it's coming back in, and how to manage that. Because you can't, let's say at a peak up here, you can't just be continuing to buy in the market and expecting that, well, some of them are going to continue to work out and keep going up. They aren't. Everything is going to crash together when it comes down, and everything's going to start going down. So that's why we need to manage that risk, and we need to manage that in the way that we're considering the whole market and all the amount of risk we have in the market at one time. So that's what we're doing here, okay? So at some point when the market begins to come back up, let's say here, and here now we're potentially at the bottom again, hopefully we're going to start coming back up again. We're going to be in this situation where we need to buy multiple cryptocurrencies at the same time, right? Because they're all going to be starting to trend again. Here that's why we're saying the number of cryptos, okay, we want to buy 10, and we want to kind of define that before, because that's going to allow us to keep track of the total risk we have in the market. And if we lose track of the total risk we have in the market, we end up adding risk as the market goes up, okay? Because we haven't been kind of saying, what's our limit? And then at some point when it crashes, we're way over our risk. So we're going to say here, we're going to buy 10 different cryptos. And here this is worked out for you, although you can change it yourself. This is the risk per trade. Okay, so each crypto will be risking 0.5% of our account. And you can see if I change this value changes. Okay, so if I was to set this to 20, this would now be 0.25, because we've got the total risk, which is 5% of our account. We're splitting that over 20 different cryptos essentially. So we're saying before, look, we want to buy 20 cryptos. We're only willing to risk 5% of our total account. That's only going to allow us 0.25% of our account per crypto. As the market began to trend up again and we started to buy cryptos, we'd only be allowed, well, we're only allowing ourselves, we can change this to whatever we want, but we're only allowing ourselves to buy 10 cryptos. Okay, so we buy 10 cryptos and we're buying them all at 0.5. And if we do that with a risk of 0.5%, we're going to know that our total risk in the market is only 5%. If a market crashes, we're only going to lose 5% of our account. So we know our risk, we're happy with that, we can deal with it. So let's say here, the accounts can survive 200 bad trades. So if we have the risk per trade is 0.5% of our account, it would need 200 of these individual trades before we blew our entire account. That's a lot of bad trades and really unlikely to happen. Okay, and that's what we want. We want the scenario where everything goes completely bad and we lose everything to be incredibly unlikely, to increase our probability that we can survive and things will work out over the long term. And then, here it's also saying the account can survive 20 market crashes. Okay, because we're only risking 5%, obviously 100 divided by 5 is 20. So we're only risking 5% of our account at any one point. So let's say there's 5 market crashes in a row. We're still not going to blow our account. And we know that, okay, we've worked that out. So that's what we really want. We want to get a really good sense, not just a sense, we want to be really specific about what we're risking to know that we can survive, because that's the most important thing. Because if you can survive, you can learn, you can wait it out. And each time you come back, you're going to be much better. And each time you're going to come back, you're going to increase the chances that this time everything's going to work out. Or you're going to be able to make it work out. Okay, so if we move down here into the bot trends list, the bot trends section, we can see that there's another risk management section down here. And this section, really, the idea of this is that it's going to tell you the amounts that you want to buy per trade. And this is worked out based on your stop and your entry price and your stop. So you can see if I move the stop level up here to say here, it's actually increased the amount I can buy in USD. And if I move it down, you can see that it decreases. And the reason for this is because you want to be losing the same amount each trade of dollar value. And because that gives you a really good sense of what's going on with your risk and how you're going to survive, right? So let's say you take 2 trades. You don't want to have one trade where you lose $100 and one trade where you lose 20. Because, if you do that all the time, you don't know which one of those 2 trades is going to work out necessarily. And it's, that's the thing. I really want to think about this in a matter of probabilities and not put any particular value on one trade too much and think that this is the winning trade. You just want to say, there's a set of probabilities that these trades are going to work out. I'm taking 2, let's say, at the same time. I don't know which one's going to work out. So I want to risk the same amount on each one. So you want to make sure that the amount you're going to lose is a dollar value. So we can see here, this is the risk amount, the percentage we're going to risk of our account. And here we've got the dollar value. So we say we're going to risk $50 per trade. If this seems like a lot to you at the moment, don't worry. You can just scale this up. This could be anything. It could be $2. It could be 10. Whatever you're kind of comfortable at the moment, and that's set by your account size, your balance, and the total amount you're willing to risk. Yeah. We want to know that we're risking the same amount. So if both of let's say we're going to take these 2 trades here, they're both $50. We're losing $50 on each trade, and we know that we're losing $50 because that's worked out for us in the app based on the amount we buy and the percentage change for when our stop gets hit. Okay, let's say our entry was here, and then we're going to put our stop under here, and we're going to say that if this triggers, this low will become a new swing low. So we're going to say that's where we want our stop to be, and we want our entry to be up here. Okay, so we can see this is 31% drop. If we buy $147 of this cryptocurrency and it drops 31%, then we're going to lose $50. But if this were to be bigger, let's say it was down here at 50%, our stop was down here, we wanted to put it under here, we actually have to change the amounts we buy now. Because if we bought $147 and this now dropped 60% instead before it hit our stop and stopped us out, we wouldn't be losing $50 anymore, we'd be losing more like 100, right? Double the amount. So it's really important that the amount that we buy is worked out based on our stop size and the stop percentage, and that's worked out also based on the amount that we want to risk of our account. If we just go back to this chart, that's why when we're moving the stop loss and the entry price and the stop loss around, we're getting different values here, because this is saying, well, if your stop loss is all the way down here, actually you only really want to be risking 77 if you're going to lose $50. So essentially what it's having to do is work backwards to work out the amount that you need to be buying, right? So everything, all this risk management, everything, what it's doing is working out these numbers. Essentially, this is the most important thing that it's working out for you, the amount to buy, right? And it's using the amount you want to risk of your total account, and it's saying, okay, we want to risk 5%. We've got the entry price and the stop price. We're going to work out what the percentage drop is between the entry price and the stop price, I'm going to say, okay, let's take that and work out if that dropped, we need to know that we're only losing 0.5% of our account or $50. Okay, and then it says, well, if all that's true, the amount would be 77 of this cryptocurrency and $158 that we need to be buying. So now you've got two ways that you can branch off and use the app now. You can either just say, I'm just going to buy these here. I only want to buy two. I'm just going to buy them, and then that's it. Or you can say, I'm going to buy them, and then I'm going to stick them in the buy list by pressing this button, and you go down, and now it's here in your buys down here, and this is just a list of the ones you bought, so you can come back later and say, okay, we just bought these, and I can kind of see whatever. Or if you wanted to, you can say, I'm going to add these to my buy list, and then I'm going to sort them within my buy list and work out the risk amounts, and then I'm going to use the buy list to actually buy them. Okay, which is what we're going to be doing. And there's an advantage to that, and that is that if you're buying, say, 10 in one go, the buy list is going to help you to sort out your kind of risk and manage it a little bit more, let's say.